This is episode 53 of the SteadyTrade Podcast with your hosts, Tim Bowen.
So ultimately with me, remember, everything boils down to risk management. You know, I don't go on roller coasters.
And Steven Johnson.
We're talking about flip-flops before, and you said you don't wear them. Now the question is, in a hot country like America, why don't you wear flip-flops?
Today we'll be covering part 3 of Tim Sykes' 14-part Trader Checklist series, available for free on YouTube. So let's just get right into it today.
Welcome back to the SteadyTrade Podcast. We're continuing our series going over Trader Checklist, which is, again, a great resource. Maybe if you're here in this episode and haven't heard the previous two, I think we're on number 3, chapter 3 today. For sure, go to SteadyTrade.com. For sure, go to our YouTube. I think it'd be great to start at the beginning, but what we're doing is working through this resource. This resource is free. You can Google Trader Checklist. You'll find it on YouTube. There's a website for it. 100% free, great stock market education. And what we want to do is Steven and I have both watched it, have both learned from it. I think Steven kind of got started with it there a year and a half or so ago. And nice. So
this is the fourth.
Okay, so we're gonna go over. We're gonna basically play some clips. We're gonna break down our input on them, and then also remember we've got a prize. You know, once we get done with this series, we're leading up into the conference. That's always a big deal in the penny stocking world in October. We're looking for you to kind of take this knowledge, take Trader Checklist. Hopefully, you pick up a few tidbits from Steven and I, and then we're gonna have you then grade stocks. And then we're going to give out a bunch of cool prizes.
Yeah, and I think one of today's subjects is risk reward today, and particularly risk. And since I am so good at managing risk, I think I should lead this episode because countless times I've shown I can really.
You're watching on YouTube. You saw me take that big gulp of water, and I think you good job capitalizing on that.
Well
Steven.
job.
You saw me take the big gulp of water, and you're bragging about your risk management.
I think whatever I say in this episode, just do the opposite. No, I'm just kidding. As everybody knows, I'm very good at talking about rules. I'm not so good at sticking to them, and that is a tough one. But I say one thing.
That will be the culmination of the SteadyTrade Podcast. Now it might take us 25 years, but we'll get there, baby.
But we've got 25 years, or at least I have, and
at least.
If you keep on going with fitness and not eating bread, you'll probably get there as well. And in fact, I just did a serious workout, and honestly, that workout that I did, a circuit training workout, that was harder than not cutting a loss. I reckon it was harder. It was harder. But let's not talk about me or we or you and I. But we'll cut all day. Let's get into the Trader Checklist.
Here's another example. You know, these are all just basic technical analysis that most traders use. And, you know, here's a symmetrical triangle. It doesn't always need to be a flat line. Sometimes you can have this kind of wedge being formed here. And this is the breakout level. Or an ascending triangle, which is what we saw earlier, where you have this flat line and you have lower or higher lows, and it's forming this kind of wedge and it breaks out. Or a descending triangle, which is what I really like to short sell when, you know, you have this level that's acting as support and it can't act as support anymore and it just crashes right through it. I love shorting this, especially when it's a blatant pump.
Actually, producer, if you don't mind, I think it would be useful to keep that on screen as we discuss it.
Me too.
And so, I mean, really the symmetrical triangle isn't really one of my favorite patterns. Now, there are a lot of traders that look for that. Oh, on that note, just Google chart patterns. If you Google stock chart patterns, you'll find a image. There's several of them, but usually it's like the first 1 or 2 or 3 images on Google Images that have all of these patterns. There's about 15 or 20 that all traders are looking for. And remember, we talked about it, I think, last episode with technical indicators and chart patterns. You're looking for self-fulfilling prophecies. And that's basically what Tim is talking about here is when everybody is looking for these charts, what's going to happen when the pattern manifests itself. And, for me, I'll let Steven kind of comment, but for me, the symmetrical triangle, I don't really like. I mean, I understand it's there, it's higher lows, etc. But I think that typically tends to fail the breakout. The ascending triangle is one I love, and especially on a day trade around that 2 p.m. window, because you can get that big spike and then you get that consolidation area and then you head into power hour and you get that break to the new high a day. That ascending triangle is probably my favorite pattern for a long pattern. And then on the flip side, that descending triangle is, I talk about back in the day all the time when I was much more aggressive shorting late day. It was kind of a different market back then, but we loved those big spikes that would then do that sideways action and then would break intraday support. Man, we would hammer those short. And again, back in the day, typically they'd gap down the next day. So if I had to pick my two favorite patterns, it's those bottom two, the ascending and descending triangle.
Well, I'm really pleased, Tim, that you didn't pick my favorite pattern, because it allows me to play a game with you that will test your IQ. Are you ready for this?
I'm ready.
Are you ready for this? Things are about to elevate to another level. Okay?
Yep.
What's my favorite pattern?
The gap and crap. So a stock that gaps up to previous resistance,
yep.
and then basically fails to fill that gap.
Very, very true. But I should have rephrased it a bit better. What's my favorite intraday pattern? Since we're talking about the ascending triangle and descending triangle, what's my favorite intraday pattern? And I'll give you a hint. Okay, you're looking at it right now. What's your favorite pattern? You're looking at it right now.
I don't know. I'm not.
Tim, this is a test of your intelligence.
You stumped me. I don't know.
Tim.
Oh, the head and shoulders. The head and shoulders. Well, you said you're looking at it, and I just thought of a lot of adjectives came to my mind when you're looking at it right now. A lot of, we try and keep it clean. A lot of profanity came to mind. But okay,
that was not bad. That was not bad. I mean, I would say within 3 or 4 seconds of me giving you the hint, I said it twice, and you got it. No. My favorite pattern by far is the head and shoulders pattern. If I see one really important thing with any of these chart patterns is if you're looking at an ascending, there's many variables. So my favorite pattern is the head and shoulders pattern. And basically, I mean, if you're looking at the screen, you'll have a pop up, which is the shoulder, which is my shoulder here, and then it'll spike up again. And then it'll make a lower high, and then it will not be able to pop back up, which forms the perfect head and shoulders. And I'm looking to kind of short the right shoulder, the shoulder here, and I'm risking the head, the high of the day. And I always look for these pre-market when there's overhead resistance, when there's not a lot of volume, and ideally if there's like a resistance level to play off as well, which from a previous time. But yeah, with descending triangles, you've got to look for other stuff as well. You've got to look for the volume dying out. You've got to look for that flat line. There's no buyers, but the sellers, and boom, and then it goes. And obviously with ascending triangles, it's the opposite. You've got to look for that big volume bar that's going to push up, which is, in the volume bar, you can't qualify how big the volume bar is. It's just got to be significantly higher in proportion than the other volume bars.
To the rest of the day. Yeah, you get, that's actually, let me comment on that, because I get asked that question a lot. I'm glad you bring that point up. Because we'll say, hey, I want to see a break with volume. And you'll give it, people will want a quantity. And it's like, maybe it's 50,000, maybe it's 5 million. It depends on how the stock is trading that day. So you're looking for relative to the volume bars, whether you're looking at 5 minute, 15 minute, or an hour, you want to see a bar that's, basically higher than the relative volume for that breakout long. Because if you don't get a big volume candle, doesn't mean it can't break out, but it's much less likely, because that's telling you the buyers aren't coming in.
Don't buy ascending triangle at 12 o'clock. That's the other thing.
Yeah. Yep.
Don't trade it. Just don't trade at 12 o'clock. Just don't trade at 12 o'clock.
You're going to see, especially like that ascending triangle pattern. If you bring up today bring up the biggest percent gainer, whatever day you're listening to the podcast. Bring up the biggest percent gainer at noon today, and you're going to see, I'm on YouTube, but you're going to see that big spike in volume, and then it's going to drop, chop in volume, and then you want that break late day. Don't trade that thin volume midday. Avoid it.
Yeah, I agree. We'll go on to the next clip, but
and then real quick, then vice versa on that descending triangle. Remember, they're basically polar opposites of each other. If you're buying that breakout late day on the ascending triangle, you want big volume. Vice versa, if you're shorting that breakdown, you want no volume. You just want people just saying, get me out and let me move on. So you're looking for the inverse basically on both of those.
Most people are looking for hot plays right at the market open. They just want to say, hey, what's hot today? What's new today? And you can take advantage of that by understanding, setups that are good ahead of time. And that's exactly what happened here on Tops. I made a few $1,000s. That's fine for me. But my students made much more. And a lot of students were selling it at 330, 350, 4, and it was just on their radar. That's what you should use my alerts and really my chat room and any chat room for. Get stocks on your watch list. Watch them in case they show signs of spiking.
I think I remember roughly the time that this was filmed, and Tops had a few kind of indicators for it. Shippers had run in the past before. Tops was a low float without being heavily diluted just yet, as far as I can remember. And it has a history of spiking. I think back 3 years ago, we had everything was spiking in the morning. That was what was in fashion. So if you saw a stock spike the day before, you would watch it for a spike the next day. And I remember Tim making a lot of money and I made a lot of money on that, but I think you'll give a more full analysis. I can see you chomping at the bit like I'm a piece of like the microphone's a piece of meat.
I think that the main concept of this particular clip and the reason the producer brought it was, don't try and trade alerts. We've talked about this a lot on the podcast. You got to have your own ideas. You need to be building your own watch list, your own research process. Now, if you're looking at Tops the previous day and it's on your watch list, and then you see a chat room or a newsletter get in it, well, that could possibly act as a confirmation of your thought process. But if you show up drunk and hungover 2 minutes before the open, like Steven, and you see an alert, and you buy that or you short that, you will never, ever be successful. Or,
I've lost so much money on alerts.
And we've all done it. I did it too.
Everyone does. Everyone does. You can't help it. It's fun. It's fun in the beginning.
It kind of is, yeah. But as we talked about, I think the second episode where we talked about Greg on Greg LX21 and all his trades being on Profitly. Use alerts to learn from. So look at why Joe Blow bought Tops at 250 and what was his rationale? What was the volume? What was the catalyst? What did the stock then proceed to do? So use alerts that way. Use them as a way to reverse engineer a trade, but never trade on alerts. You'll get lucky once in a while, but you'll never be consistent because it's got to be your idea. It's got to be your plan. It's got to be your pattern. All these things are your time of day. All these things that are part of the prepare in trader checklist. They all got to be your criteria.
Yeah, and just to add, I know someone else who's more like LX21 hasn't updated for a while, so if you're looking back on the charts, it's kind of back a few years. But Roland Wolf, I've been through his Profitly lists, and he gives actually quite descriptive analysis on all of these Profitly trades. So he's probably another one to look back on Profitly on as well.
I do like to see an uptrend before a breakout. It's very tough, as you can see here, even though there was actually no news right here on this breakout. The really big news was right here. And sometimes the news does not lead to a successful breakout. and no news can lead to a successful breakout. Very important for you guys to understand that, who think that, oh, these stocks only move based on news. Sometimes the breakout itself can become the news. I mean, it's pretty tough to see that it broke this key level. And so when it did it successfully.
So great technical analysis 101 there. You notice how, notice how he was waiting for it to actually break. If you saw 2 times before, it spiked and failed, then you wait for it to actually break, because that brings it on everybody's scanners. It's on everybody's radar. Everybody is looking at it at that point. And it was quick, but Tim made a exceptional point, especially for, we're recording this summer 2018. It sounds very counterintuitive. He's like, hey, this stock failed to break on news, which XXII is the worst, terrible stock. They make low nicotine cigarettes. If you're going to smoke cigarettes, at least if you're going to smoke cigarettes, just smoke Camel unfiltered like a real man. But anyway, XXII.
Just do yourself the real way. Do yourself the real way.
Well, why do it slowly, man? Just go all in. You're smoking cigarettes. You got 763 chemicals in those things. Why smoke a low nicotine cigarette? Anyway, terrible stock. Terrible stock that has a history of failing. But right now, the biggest movers have no news. And you might be like, wait a minute, why would the biggest movers have no news? Because and Stephen can offer his input. There's so many aggressive short sellers out there now that they see a stock up big, they see no news, they pile in, and next thing you know, you get a 300% spiker because everybody's like, there's no news. It's got to come down. And it's funny, Sykes made this comment, 2 years ago, but this summer it's been very applicable. The biggest movers have had no news.
Yeah, no, like when you look at that chart, there's like 3 things that immediately fly out to me. If the producer, if you can just pull the chart back, like there's 3 big standout points that come straight out. It's like another language. You learn to read these things in a mental way. The first one is this is the 3rd time it's tried to break out. So generally, the more times it tries to break a key level, the more likely it is. The second thing is if you look at the volume bars, the last 2, like the last time it tried was on 1.8 million. So if it does get above that breakout level, because it's breaking out above a level that's a high volume level, that means that the volume is going to be even more powerful, because it's the more volume it breaks out from, the stronger the breakout is. And the third really interesting part about this chart is with this breakout, like the time it tried to break out on October 1, 2013, like it's not going to have a good chance of breaking out when it's already come from the 1.2s to the 1.8s. It's going to struggle because it's come too far too fast. But when it's kind of been edging up on the daily, inch by inch by inch by inch, all of these longs have got a lot of support levels to fall back on, and the shorts haven't really got much downside. So it's really going to kind of break out that 180 level because, well, there's much more chance of it because longs are covered with a base and shorts have got no real downside.
Very well said, Stephen. I agree with 100% of that. No, that was well done. Well done.
I get disciplined. One day when I stop losing and I get disciplined, I'll be a little STT pro teacher. I'll be the little protege, but I've got a long way to come.
It's counterintuitive what works. I know a lot of you guys just want to buy stocks when they dip 50, 75%. You're like, hey, I was taught to buy low, sell high. When a stock drops a lot, it's probably for the wrong reason. So let me just buy it on the dip and sell. With penny stocks, with low price stocks, you can't do that. If a stock drops 50 to 75% in a day or a week or a month, the company is probably going to do something really bad. Okay? You have to remember, most penny stocks fail.
Yeah, there's guys that can dip buy. There's guys that are good at it. There's guys that recognize the right setup. I mean, the classic dip buys, especially like an OTC stock that may be promoted that's been trending for, I mean, we've had them trend for like a month or 2 months, they're up, 300% in 2 months, and they drop 50% at the open, you've got 2 months worth of longs in there that are going to add and in theory push it back up. But there might be no thing Tim Sykes has ever said more that I agree with more than not trying to dip buy sketchy penny stocks. I mean, the most of the time they're up for no reason. They may be manipulated. They may be promoted. They may be, doing a sketchy financing, insiders. I mean, there's all kinds of bad stuff. So you ride them up, short them on the backside. But in my opinion, I've maybe dip bought a low price stock once or twice in the last 5 years, and I can guarantee I lost both times. So, and when I say dip buy, the idea with a dip buy is you're looking, again, this is kind of back to the classic sense. You're looking for a stock that's been strongly uptrending for a long time. So it's, it started out here and it's way up here, and then it yanks a huge percent in like one day. Maybe it's 9:35 a.m. and this thing's down 40, 50%. The thought process is, since it's been uptrending for so long, you're going to get a lot of longs that are going to say, oh, here's an opportunity to add to this position, and that buying will push it back up. So, but, I believe in Steven getting more than one workout in a row multiple days more than I believe in dip buying. So,
yeah, no,
have you ever tried it? Have you ever dip bought anything?
No, but you will dip buy. In a sense, you'll dip buy when you dip buy in week open red to green.
But I'm waiting for it to go back green. It's green on the day at that point.
Yeah. But in the sense of dip buying isn't catching a fallen knife. In that sense of dip buy, and you're gonna get your hands bloody. The best piece of advice I would give is have a plan. Have a plan, because if you're gonna you might say the bottom might not come, so I'll take a small starter here, and then I'll take a big starter if it actually gets down to this level. That's reasonable as long as you plan it to do that. But do not average down and down and down into a dip buy. It's the fastest way you'll blow up an account.
Yeah, really, think of adding to a dip buy as bad as adding to a short that's going against you. It's basically the same idea. They're inverses of each other again. If you're adding to a short that's hitting the new high of the day, it's always going to end bad. And if you're adding to a dip buy that's going lower, it's always going to end bad.
Yeah, and if you are going to dip buy, make sure you dip buying off a support level somewhere on the chart, from the previous day or a support level from a few months ago with volume. That's the advice I'd give. And the only time I've ever dip bought successfully is pumps. If there's a pump and it's going up every day, and then for whatever reason it absolutely tanks and it's in the morning, it's in the first hour of the morning, very often the promoters will save it, and once you see it turning around, you can pick up 20-30% on pumps like that. EMMD was a great pump 2 years ago, and it did it a few times.
Yeah, that thing bounced 3 times, didn't it?
Yeah. And once you see it get rescued once, it's going to rescue again. The other absolute no is dip buying anything in the afternoon, because if it falls apart in the afternoon, it's probably not coming back.
Great point. Yeah. And we'll always get asked about this. You mentioned the pump and dump. So remember, it's 2018 when we're recording this. The traditional pump and dump, where it's a promoted stock with email newsletters or hard copy mailers, these are very, very, very few and far between. So if you're watching DVDs or YouTube videos and they talk about pump and dumps, the market has evolved. Back when I got started, all day long we had pump and dumps, all the way up until 2013, 2014, and maybe a little later, but they've really cracked down on them. So I get asked all the time, hey, what's the latest pump? Well, about 48 weeks out of the year, the answer is there is no pump right now. Now, stocks are still heavily manipulated. Look up the news on AWX for the week of July, or for the last week of July 2018, and you'll see stocks are still heavily manipulated, but the quote-unquote pump and dump is very, very few and far between anymore.
Yeah, and that's another reason why you should stay away from low float stocks, because the low float
they're the heavily manipulated ones.
Yeah. The ones that are heavily manipulated, they are designed by clever, intelligent people with lots of money to basically fuck retailers. So, I mean, in my opinion, they're designed to really scam a lot of traders out of money, and they'll trick you, especially if you're a beginner trader. You'll fall into all of the mistakes.
Yeah, so we're going to save this discussion for a future podcast, but the low float idea and the cornering the float idea is how stocks are manipulated right now. So we'll save it for another day. It's a long discussion. Especially the low floats are very heavily manipulated right now, but it's a whole nother podcast.
And AWX.
Next clip.
Here's another play I missed. I don't mind bringing up plays I missed, because even though I missed it, I know I'm on the right track just by almost being there. With KONE, I didn't want to chase it. My rules prevented me from chasing it. But again, sometimes, in this market especially, it pays to be a little speculative. I was speculative with TOPS and I was rewarded. I was not speculative here, mainly just because it was the middle of the day and I wasn't rewarded. But I'm not going to change my rules just based on one play. If maybe 10 or 20 or 100 plays start breaking out at 10, 11 a.m., then maybe I'll adapt. But the vast majority of plays that I like spike right at the market open. And here's another example, MDGS. This was this week, and I missed my buy right here at $2 a share. Pre-market, it was already uptrending. They had a good contract. I believe it was from Johns Hopkins. And they make this medical procedure machine, and Johns Hopkins Hospital ordered this machine. So it was a contract winner. It's uptrending pre-market. But look at the volume. The volume doesn't really happen until the market open. And I tried to buy this right at $2 a share. If you actually pull up a chart of MDGS, a longer-term chart, you will see that $2 a share is a big multi-year breakout, multi-month, multi-year breakout. I had a chance to chase it right in here at 230. You can't really see it, but it paused for about 30 seconds here at 230-ish. And I could have changed my buy order. I was just trying to buy 5,000 shares. I could have bought 5,000 shares here at 235-ish. So I would have paid roughly $1,500 more, but I didn't want to chase it. As it turns out, I should have chased it in this market, and this is all in the first 15 minutes, and it goes from 2 to 325. I missed it personally, but I brought it up pre-market to my students in the chat room, and I would guesstimate maybe 300 to 400 students profited on this. And we're talking about profiting, buying it at 2 or 220 and selling it at 3 or 320, making 50% on your money inside of 15 minutes. And then it did nothing, and it went straight down. But this is just an example of how quickly these spikes are happening.
If you could keep that on screen, producer, please. Man, it's funny right there. Perfect. It's funny how we talk about former runners a lot, and people always be like, "Hey, how do you know former runners? How do you locate them? Where's a list?" There is no real list of former runners. It comes with experience. It's funny though. I think the trader checklist is 2, maybe 3 years old, and Sykes has a chart of MDGS, and MDGS 2 weeks ago went from 1 to 10 in a day. So it's funny how that's why you want to, whether you use your notebooks, whether you use Evernote, whether you use a PowerPoint presentation. I love saving charts to PowerPoint. You could have like this daily chart of MDGS in your former runner PowerPoint. Okay. Then you save the chart from 2 weeks ago when it went from 1 to 10, and you look for these tickers that repeat, because the ones that ran in the past tend to run again. And man, it's just funny to see them repeat. And I love this chart. I mean, I don't remember this exact day, but Sykes says there was news This is a low float stock. It's uptrending in pre-market. After the open, it breaks a whole dollar, half dollar of 2. VWAP was probably 175, 180. I'm guessing he doesn't have it on his chart. You buy that break of 2, you risk VWAP. You're risking 20, 25 cents. The thing proceeds to spike to 3. I also love, and we talk about this one in StocksToTrade Pro every day, I love that it rips a buck, yanks, and then reclaims the high of the day at about 9:45 a.m. Love that move, man. On a low float, you know it's heavily shorted. It's got news. It yanks like 50 cents right there, then hits that high of day again at 290. So I wouldn't buy that dip. I'd buy the rebreak out, and then I'd risk the dip. Yeah. So
very nice.
Meanwhile, you'd be shorting it all the way up.
Do you know what the funny thing with that one is? And I don't know if it's maybe just a one-off stock, maybe the volume was lighter, but to spike $1 a share, like it's gone it from 2 to 3. It's spiked the buck a share from 2 to 330, and it's kind of doing it. And the minute volume's only like a few 100,000, 300,000. So it's moving a lot on kind of light volume. I mean, I was just surprised by that because normally you'll see like 500,000, 600,000, 700,000. I just wonder, I mean, if it's just a random example of just in general, the market and penny stocks are getting heavier and heavier and heavier.
Oh, yeah. I great point. So. Man, Steven, you showed up to work on point. You combed your hair. You're paying attention. You're making great points. Jeez, oh, Pete. So no, great point. I mean, man, one of the, wasn't it? So you talk about, first of all, I think this is from 2016, and you talk about the difference in volume. Remember, I flipped from being a 90% short bias trader pre-2016 to being 90% long bias because I recognized exactly what you said. There is so much more volume in low price stocks now, man. You're looking at a couple 100,000 shares on MDGS. The other day when it spiked 2 weeks ago, it traded 15 million in one day. So you're 100% right.
Yeah. Okay, let's ride that wave into the next one.
Here's another example, you on demand. And I just want to show you chart after chart after chart to get an understanding of the kinds of moves that I like, the kinds of moves that are possible, even when there's not that many signs ahead of time. Here's a 14-day chart of you on demand. They're like a little wannabe Chinese Netflix, except they just have hardly any subscribers or any business. This was in my long-term portfolio for a while, and it just did nothing. This spike here from 260 to 330, I mean, they announced a deal with Disney, okay, which is a huge, huge win for a small company like this to be able to distribute Disney films. And the stock did absolutely nothing on that news, and it came right back down. What spiked the stock from the 2s to the 4s, and actually I think it even got up to 7 the next day, was a Seeking Alpha article that said this could be the next Netflix. So a contract with Disney didn't spike it that much, and I was actually disappointed. I remember I was buying this, and I think I got out. I don't know if I got out for a small gain or a small loss, but I was definitely really angry that the Disney deal, I think it was their biggest deal of all time at the time, didn't do much for the stock, and then this stupid article, did it. So the lesson from this is that you can't choose what's going to happen, okay? Some stocks are going to spike on, just news, like when the media picks up on a story. Sometimes it's going to spike on earnings. Sometimes it's going to spike on the hottest trend, like TOPS, SPU, OPTT right now. You just have to be open to it all. Be receptive.
If we just jump back, I'll let you comment, but two things just immediately stick out to me. If we just jump back on the chart a little bit, if we just go back, I don't know what the history is beyond that, but I would guess it's probably a downtrending chart. I'm not sure. And maybe I think that initial spike where it's failed around, is it February 10, February 11 on the Thursday? I think it's just gone a little bit too far too soon. And it's not on a whole lot of volume, but we can see when the breakout does happen, it's on significantly higher volume. and you've got a load of breakout buyers. The next time in the 320s, you've got a load of shorts piling in for the double top, and then just what happens when it breaks, all the shorts are basically stuck, and they're all covering higher and higher and higher, and all the breakout buyers are buying and buying and buying. And for me, I don't think it's so much about the news. Maybe the news was the catalyst, and it's a variable, but it's more the thought process of the traders. Shorts are shorting at the top, breakout buyers are buying, and then when it goes one way, it'll go away with a bit of momentum, and it'll just push and push.
So one of the benefits of being 85 years old is I've been through all this stuff, and it's actually a good something just to kind of point out on YOD. And I traded this too, and I don't remember how I did. I don't think I did anything particularly great, but this is back when the Seeking Alpha pump. We talk about pumps. And remember, all these things are evolving. So Seeking Alpha is a blogging site, financial blogging site. Check it out. It's gotten pretty sketchy over the last couple of years. But what happened was about 3 or 4 years ago, and don't quote me on the dates, but basically Yahoo Finance was like the biggest finance website, trading website forever. And Seeking Alpha got a deal with Yahoo Finance where all of Yahoo Finance would pick up all of the Seeking Alpha articles. So this is back in the day, we called it the Seeking Alpha pump. So the point Tim makes is they had a real deal with Disney, didn't move the stock because nobody cared, because nobody was looking for a real deal on YOD. What they were looking for was when it hit Seeking Alpha, they said, oh, this is the latest Seeking Alpha pump, let's pile in. So that it's an interesting contrast in how things change, where you go from a real contract with one of the biggest companies in the world to a pumpy, promoty website. Now, Yahoo Finance and Seeking Alpha ultimately fell apart. That partnership ended, and now basically nobody cares about Seeking Alpha. I mean, it's like it's out there, but it doesn't move stocks. It used to move stocks.
I think that's a great analysis, Tim, and I think that's a good lesson for me as well. And this is why you get
that's your daily dose of history of the world of penny stocks.
This is why you're the big earner. You've justified it. All right, next.
I want you to understand how quickly this stuff can change. So when you see commentary, or if you see me having a buy alert, I don't really like buying and shorting the same day. I actually tried to short tops that day that it was breaking out, and that was a bad idea. I had to cut losses quickly. It confuses students because they're like, wait a minute, you were buying this stock and now you're shorting it. Which one is it? Make up your mind. And, I've been called like this politician, like flip-flopper. And I'm like, well, that's what trading is. You're not married to a position. But I know it's tough for beginner traders to understand why a company might be a good buy for 10, 15, 20 minutes and then a good short for 30 minutes. But this is a good example of exactly how that can happen. It totally depends on the price and the pattern. And as you see more and more of these, you'll start to learn that. So this is why I say I'm a glorified history teacher, but it's your duty to study that history.
Couple very good points there, and I agree and disagree with Tim on that. He talks about trading the price action. Ultimately, if you're day trading an 80-cent stock like GRNH, you're not investing in this. You're not holding it overnight. You're strictly trading the price action, the momentum. I mean, if it's ripping on big volume, you're looking to buy. If it's fading on fading volume, you're looking to short. And you can make money both ways the same day. Now, and he kind of touches on this, I say, as a new trader, avoid flip-flopping. As a veteran trader like Sykes, you can do it all day long. He's been around the block a million times. But, man, if you're bearish, and then you get stopped out, and then you start trying to buy the stock, and then you try and short the stock. I say as a new trader, as a new trader, form your bias. I don't care if you're long or you're short. Whatever your bias is, do your worksheet, do your trader checklist. And if you're bullish this stock and you buy it and you stop out, don't try to then short it the same. I mean, it's just your psychology is messed up. Instead of re-entering that trade, analyze the trade, see why it didn't work, break it down. But as a new trader, please don't try and sit there and flip long and short all through the day. So,
yeah, I mean, for me, it just looks like a horrible chart, and it's not the type of chart I'd play. And if I was going to play it anyway, I'd play it short. And if I was going to play it short, the reason it's a nice short is because it's really come so far, so fast. But it would have to have a real serious history of failed spikes, and it would have to be into a wall of previous multi-week, multi-month resistance, and then you've got some level to play off. But for me, I would never touch it long, and I would in my olden days when I was a bit more risky, I would probably took it short, but probably not anymore.
So like last week.
But,
so the olden days, like last week.
I still do dumb shit, but we're talking about flip flops before, and you said you don't wear them. Now the question is, in a hot country like America, why don't you wear flip flops?
Well, why would I? Let me start with this. Why would I wear flip flops?
It's like air conditioning for your feet because you're permanently feeling a breeze on your toes. It's like air conditioning for your toes when you wear flip flops.
So
let's my argument for when it's air conditioning for your toes. Yeah.
Okay, so there we go. So back to my roller coaster.
Hi, this is Aaron, aka Double A Ron from New York City, and I like to go outside and find a stray dog, preferably an aggressive breed like a pit bull or a Rottweiler. Then I get real close, stare it down eye to eye until it starts to chase me. Then I run. That's right, I run while listening to Steven and Tim on the SteadyTrade Podcast. You can register to win real actual prizes at their website, SteadyTrade.com. And if you really like what you hear, give the podcast a 5-star rating and write a glowing review on iTunes. I did, and this is how we say goodbye in New York City.